All right, we are live, and let's go into Composer here because that's what I want to discuss today. I want to discuss Composer and specifically a strategy that I've developed, which I've called Permanent Store of Wealth. And the reason I want to discuss this is, one might think Composer targets more day traders, swing traders, quant traders, um, and it certainly can and does perhaps. But even if you're more of a conservative buy and hold esque investor, there's still some cool things that you can do here. And so basically, let's talk about a permanent store of wealth. So there's different philosophies, different strategies. One that's very popular is the 60-40, which is 60% stocks, 40% bonds. You have Ray Dalio's All Weather, which Tony Robbins kind of shared with the world in his interview and writing about it in Money Master the Game. You can Google All Weather Portfolio ETF, and you can see what the ETF version of that is. And so one that I've developed that, let's say I compound capital to 76 million, and I were leaving that either to charity or to whomever. So I would probably leave the 76 million in this strategy. And, so just let's take Warren Buffett, for example. He's decided he's leaving his estate to 90% VOO, so 90% S&P 500, 10% short-term bonds. So this is a little different. It's not a 90-10 or a 60-40. Mine is a 70-10-10-10. And so the 70% is equities, the 10% is bonds, 10% is real estate, and 10% is commodities. So the real estate and the commodities are the two kind of outliers. Not a lot of people hold those necessarily in permanent portfolios, especially the real estate. But I personally own real estate. I love real estate along with the stock market. And REITs can also serve in a way as a bond proxy, which is cool for the income. But yeah, so it's a 70-10-10-10, and I was able to create it in Composer. So let's scroll down, and it's going to be in the P's, and let's shrink my screen just a little. There we go. So I can click on it. Permanent store of wealth. So again, what distinguishes Composer from, let's say, somewhere like M1 Finance or what I used to do in motif investing? So let's bring my screen up a little bit here. We can do that. Yeah, we can. And so in something like motif investing or M1 Finance, I believe you can probably create the holdings based on a percentage. Okay. So I could go in and create, this ETF at this percentage, and then it gets rebalanced. But a cool feature of Composer is the grouping. So why is that superior? Well, look, I have 70%. I've created a group called equities. In that I have VOO, QQQ, DIA, VEU. Let's say that I wanted to add another ETF that I love. And let's just take Noble, NOBL, which is my ProShares, which is the Dividend Aristocrats. And let's say I wanted to add a fifth one here. Well, it's going to do so seamlessly. I'm not setting, like, for example, the exact percentage of VOO, QQQ, DIA, VU, and then I would need to change that that feature. I can just weight equal. So if I wanted to add 5 more or 10 more, I wanted to take one out, 70% of the entire portfolio is going to weight these equally amongst that 70%. So that's a really cool feature. So let's go through it just in depth and why I made these decisions. So you have VOO here, which is Vanguard 500 Index Fund. You have QQQ, which basically tracks the NASDAQ 100. You have DIA, tracks the Dow, and VEU, which is, it's sort of a global equity fund except the US. And why did I choose that? Because these three are US based. And I feel that you want to have a global tilt. So you get the three US based, and you get the three biggest indices. So you own the S&P, NASDAQ, and Dow, and then you get a global fund here. So that's the 70 equities. And then you go real estate. VNQ is the real estate fund. Again, if you're going to choose one fund for real estate, that's kind of the fund. Again, I went global. This is the global X US real estate. So it's the VEU of real estate, right? Meaning it's the real estate except the US. And then there's a third one I added here, NETL. I really love triple net lease REITs. I think you have things like Realty Income, Agree Realty, and some others. Realty Income is probably, I think, the most well-known of the triple net. So this is one that holds all the triple net lease REITs, 10% again. But if I added a fourth or fifth on my rebalance, it would be calculated automatically. And then let's go off to bonds. So bonds, again, you're going to have one choice. BND is total bond market. So BND is to bonds what VOO is to stocks, and VNQ is to real estate. And then again, total international bond fund, total world bond fund. So I'm going global with the next two holdings. So instead of just a total bond index, now I go to long-term treasuries, TLT. That's oftentimes negatively correlated with equities. And then I go in some two other things. I go long-term corporate bonds. So I go not just government bonds, I go corporate bonds, and I go TIPS. There's sort of this debate amongst economists now is inflation transitory, or is the Fed wrong and inflation is not transitory? And we're going to go into an inflationary period. And so this is a bond fund that tracks inflation tip. So if that were to happen, this fund would jump. And we go last grouping, commodities. So we go gold strategy, which tracks gold. We go silver. We go global silver miners. We go gold miners, and we go energy here, XLE, and DBC, which is a commodity index. So you can see here I'm wanting gold, basically gold, silver, and a broad-based commodity index. So, with the gold I have, the gold strategy, which tracks the price of gold miners with the silver miners, and then oil and gas here in XLE, and then the broad commodity index. So again, whatever the total, let's say for example, the total portfolio is 100,000. So $10,000 would be allocated to this commodity, and then it would be divided equal weighted amongst that 10,000 and these, and then that would, again, if I were to delete one or add one more, it would do that calculation. And then I have it set for yearly. Again, for most long-term holders of wealth, they're going to maybe do a yearly or every second year rebalance. So one of the cool things I think they might add in the future is to be able to go out a little bit instead of just yearly. You might be able to set it for like 2 years or 3 years. I don't know if that's the case, but a yearly rebalance is fine. I think that in the long term will be a good decision. So that's the permanent store of wealth. So again, let's say someone called me and said to me, I just won the lottery, and the after-tax amount is $8 million. And I want to invest, but I don't know much about investing, and I know that you do, and you like to invest, and you've done well with it. What is it that you recommend I do? This is one where, look, you're not going to shoot the lights out on this. You're not going to compound at 25% like on some of the derivative based leverage strategies. But this is a solid store of wealth. I just feel like you never want to say this can't lose. It's the words of the Titanic, right? But, because you have things that are negatively correlated, because you're rebalancing, because you're diversified not just among stocks and bonds, but you're adding in commodities and real estate, I think you're just in a great place with this portfolio. So I would say to that person, the $8 million would be best allocated here. Or, even a simpler thing would be just 100% VOO, which is the S&P 500 index fund. But if you wanted to get cute, you wanted some diversity, this is something that would definitely do well, and it would probably have less drawdowns than just VOO. So yeah, and what I did also, so this is the main permanent store of wealth here. And then what I did, let's go back here. And then I'm going to do some back testing on this one. Then I thought, okay, so I have, let's say, 4 or 5 ETFs per grouping. What if I wanted to keep it super, super simple? And on the different groups, just to have, I was forced to choose one ETF. Okay. So let's go down, and I created, let's go to smaller screen so I can find it. There we go. So you can see this one's permanent store of wealth 4 index. Now you can see the year to date, actually the simpler one has outperformed the more diversified one. Okay. So let's click on this here. So again, permanent store of wealth. Let's raise my screen a little bit now. Okay, so permanent store of wealth, 4 ETFs. So you know, as stocks, bonds, real estate, commodities. And again, like I said, if I were to choose one particular ETF where I were holding all my wealth, it would be in VOO. And so you see the S&P 500 right here. Bonds, Vanguard Total Bond Index, real estate, VNQ. And here, one might say, oh, I'd rather hold gold than a commodity index. You could do that. I mean, certainly you could play with that. But if I were choosing one, this is just like a broad-based commodity index. So let's do this. Let's take this now and go jump to backtest. So there we go. And so let's get rid of this one here, because you're able to compare symphony to symphony. So let's just keep it simple at first here. So it's comparing against SPY, and it's likely to underperform SPY. SPY again is basically VOO. You could add VOO here, and it's SPY. So I don't know if we can. Yeah, let's just add VOO because that's the one I've been talking about. SPY and VOO should almost be exactly the same. I mean, it should almost be hard to see the difference. Let's see if there isn't much of a difference. Okay. So you have, yeah, like you can't even. It's kind of cool actually. You can't even really see the difference because they're almost the same. And then let's see, actually, you can see here the number. Wow. So VOO's return is 138.95. SPY is 138.04. So again, even just actually doing some cool back testing like this just happened randomly. I'm doing this, but like if you say, oh, I want to do like an index fund, which has performed better? So you can just like back test VOO and SPY, and you can see that VOO has done just a little bit better. But, again, you can see that the permanent store of wealth has underperformed the S&P and VOO, which are essentially one and the same thing. As I said, it would, in that the goal here is not to shoot the lights out, not to outperform the index. It's simply again, notice the title, permanent store of wealth. If you won the lottery, if you had an inheritance, if you've built an estate up over a lifetime, and you wanted a place where you didn't want to trade in and out of stocks, you didn't want to deal with owning physical real estate and tenant, toilets, termites, right? This is something. So let's just scroll down here and look. Let's shrink my screen. Again, you can totally kind of geek out, on this. That's the term I like to use. And you can really get into the numbers and the data. But so again, let's look at max drawdown. You see here, it did exactly as I said, is that I don't think the drawdowns in the permanent store of wealth will be as drastic as in just VOOSPY. It's a good 4 percentage point different. You know, and its Sharpe ratio is, it's a little bit lower than those two. Let's see, over 1 month, 2.9, 2.9. See, it's a lower standard deviation. So, which means it's less volatile, less movement because of that negative correlation and such. But yeah, you know, again, that's why I say to people, you're certainly fine also going 100% VOO, but for someone to be 100% in stocks when there's massive drawdowns, that might not appeal to them. Let's try to go back. This is from 16. So let's now go back to 2011. So let's do that. January 1st, 2011. And let's do this. And what's cool too is by doing the back test, and you might think you've created like the greatest strategy ever in your head. And then when you back test, you're like, it's okay. Or yeah, you know, but I'd be better off just owning the index. You know, so let's scroll down here and let's see what this gives us. Okay. Actually, did it? Yeah, to 11. Okay. It looks like the same here on the max. Oh, the max drawdowns are the same. Okay. So yeah, 11.5% on the permanent store of wealth, 14.6 for the Vanguard S&P and SPY. Sharpe ratio 0.83. Again, it's a lower standard. Again, you're going to have lower standard of deviation and lower max drawdowns generally with this. But you're likely to underperform the S&P index. But the thing I would say is, look, if you're, you know, this is a good thing to discuss here. So if you've inherited 8 million, or if you won the lottery for 8 million, your goal necessarily isn't to be David Tepper or Carl Icahn or Peter Lynch or John Templeton or Warren Buffett, and try to compound at 22, 29%. Your goal might be that the preservation of capital is as important as the growth of capital. And look, there's certainly nothing wrong with an 11.5% annualized return. You're going to do very well with that. But it might cause you pain to see a portfolio go from 8 million, you know, and there's periods where stocks go down 40, 50%, to see it go from 8 million to 4 million. You know, maybe you can't stomach that. I mean, volatility doesn't bother me. It's like, for me, it's like a boxer who can take a big shot. But for some people, any little volatility bothers them. And so this is something where, yeah, that basically you're going to get those less drawdowns, you know, and so you'll sleep a little bit better at night with that. It would be fascinating to track this even further back. Like even, I don't know if you could do it with like the 1980 or something, or 1970 or you know, but again, I would probably say that this give you the same result, that the S&P will outperform, but this will have less max drawdowns, less standard deviation. So yeah, so just to finish that last thought is, you know, it was Charlie Munger, I think, who said you only need to get rich once. And so with that, you hear, you know, these stories of lottery winners, or, you know, professional athletes, or actors and actresses, you know, who just had millions, if not hundreds of millions, that went completely bankrupt. You know, so you only need to get rich once. And when you get rich, it's as important to conserve capital as multiply capital. You want to do both. So it's a balance of offense and defense. And I feel that this 70-10-10-10 portfolio does that quite nicely. So yeah, so I hope that kind of gives people just a sense of just an investing philosophy that I've developed. And actually, I mentioned my mother's annuity. I actually have her as 80-10-10 because the annuity company doesn't have a commodity or gold or silver index. So I just went to 80 equities, 10 bonds, 10 real estate. And again, you can get cute with this. You could be watching this and saying, well, you know, I like the 70% equities, but I just feel that bonds, the traditional bonds, are too underweight at 10. And I can go, you know, I want to do 20% bonds and 5% commodities, 5% real estate. With Composer, you can go in and do that. You can create whatever you want. You know, you can be your own Picasso, right? So, so there it is. So that's that. I hope you guys enjoy this. Very excited to really keep tracking this and creating new symphonies. And I'll see you soon. Ciao.